Hi everyone. Very good evening to all of you all, and we would like to warmly welcome all of you who are joining us today for today's session from both locally and overseas. At Almas, we believe in sharing, and this is another step of a series of sessions Almas Group is arranging to share knowledge. Many of you would recall we conducted a very successful session earlier on Sukuk products with eminent participants. Today is yet another session with valuable knowledge relating to whitelist screening of stocks, where knowledge is shared with you by our eminent resource personnel. Let me introduce today's resource persons to commence today's proceedings. I welcome Sheikh Muiz Bukhari, Vice President Sharia Advisory at Almas Group, Mr. Yahya Ilham, Senior Analyst Sharia Advisory at Almas Group, Mr. Rizvi Abdul Majid, Director of Almas Group and Director of Almas Equities, Mr. Rosli Shamsuddin, Director of Almas Group and Director Almas Equities, Mr. Shamir Buhardin, Director Almas Holding, Vice President, Admin and Marketing of Almas Equities. Last but not least, Mr. Imtiaz Buhardin, our Group Chairman of Almas Group of Companies. I'm Dr. Harshana Surya Perumal, your moderator for today's session, and I'm also a director at Almas Holding Company. May I kindly invite Mr. Imtiaz Buhardin to formally welcome all of our participants for today's session. Mr. Buhardin, over to you.
Thank you very much, Doctor. Assalamu alaikum wa rahmatullahi wa barakatuh. Good evening to everyone. We welcome all of you who have joined us today to mark this important milestone of sharing the details related to Almas Whitelist screener. I'm pleased that the Board of Directors of Almas Equities Private Limited has organized this timely initiative to provide the Sharia compliant and comprehensive approach for the benefit of interested parties to categorize the companies with the basis for such categorization. Currently, there are no independent or exclusive standards to cater to the local market in Sri Lanka to publish a whitelist screener. After a lot of research and discussions, we are going with a new approach where we check against 5 global standards provided by prominent bodies to a stock, and if it meets the guideline of a particular standard, a star is awarded. This will allow the individual investor to make more informed decisions relating to a stock. Research team, including the guidance from Sheikh Muiz Bukhari and members of the in-house Sharia advisory panel, including Mr. Yahya Ilham, together with the team have invested countless hours in developing the method, where one company could be viewed from 5 international standards to provide an outcome which is more in line with the principles. In addition, we are humbled to say that Almas has many novel features. Completed the first in Sri Lanka's comprehensive live whitelist, which is updated as and when financials are released by companies in the future, hopefully from December quarter. 2, Almas Whitelist has a search bar that will allow the investor to easily search any stock listed in the CSE. 3, further, Almas Whitelist allows live filtration of the stocks under different criteria, including the company name, symbol, industry, or sector. Different international standards and stars for meeting the standard. The team behind this initiative has informed me that Almas approach has considered reputed international compliance methodologies and benchmarks adopted by major preparers of whitelist in order to provide a comprehensive yet independent and unbiased review of the companies. Team has researched extensively and adopted internationally acclaimed, widely adopted standards, namely 1, AAOIFI from Middle East region, 2, Mizan from Pakistan, 3, Dow Jones from USA, 4, Securities Commission Malaysia, and 5, BSE and Nifty from India to represent our region. We at Almas believe in investing in knowledge and sharing with our clients and others who are interested to learn more on these areas. We believe that we have a credible process in place to provide more details with accuracy and more depth through analysis. The time we took to finalize Almas Whitelist Screener was due to significant efforts since we started the initiative, including additional time to engage with more PLCs. We are thankful to the PLCs who cooperated, including some of the listed hotels. We wish to continue to engage with more PLCs to make the list more comprehensive. In general, looking at financials doesn't give all the information that requires to determine whether a company is in the whitelist or not. Therefore, Almas Equities, being a regulated and licensed brokering firm, was able to engage directly with PLCs to seek clarification relating to their operations. Similar to our engagements to educate you, we'll continue to engage with PLCs to create awareness, to broaden the whitelist to enable you to have more options, particularly because some companies are marginally outside thresholds. It is widely accepted that the Sharia compliance for companies means a healthy financial position. As indicated earlier, these parameters are widely adopted internationally, including the Dow Jones Islamic Market World Index in USA. Therefore, one could argue that apart from being religious reasons, these are globally accepted principles to review and identify companies with healthy financial status. Today, we will launch our new interactive live website for whitelist screening, and we plan to move up with the digital engagements in the near future, where it is in pipeline to have a mobile app for real-time access to Almas Whitelist Screener, and it will promptly alert you when new updates are available. We are also in the process of finalizing a 100% Sharia-compliant buying power product and developing a customized solution. We are currently working with partners to develop the required applications, which will be another first in Sri Lanka brokering industry. In the near future, inshallah, we will also intend to organize other webinars, including that of matters relating to zakat and its relevance to the stock market. In the future, as and when a company declares a dividend, we intend to inform how much is the purification amount required, which will be available in our websites, and it will broadcast to all our clients. As the presenters are ready, I will not take more time, and I would like to wish all the best for a fruitful engagement. More detailed elaboration of these areas will be presented to you by other presenters. I wish all the best for a productive session. Jazakallah khairan. Thank you. Over to you, Doctor.
Thank you very much, Mr. Buhadi. This is a novel whitelist screening methodology that will empower you to make informed decisions on which is more appropriate for your circumstances. To learn more and to start the conversation on whitelist screening, may I now invite Sheikh Moiz Bukhari to start the proceedings. Over to you, Sheikh.
Thank you, Doctor, for the introduction. Assalamu alaikum wa rahmatullahi wa barakatuh, and a very good evening, everyone. I would like to start off by praising the Almighty and thanking Him for the numerous blessings that He has blessed us with. And I pray unto Him, O Allah, O Lord Almighty, please guide us and give us the skills imperative in our chosen field. Give us the grace to control our emotions and the ability to read the markets in the best manner possible. May our charts guide us and lead us to the right path. May our wins humble us and our losses teach us valuable lessons. May fear give way to peace, and may our greed surrender to charity. O Allah, may we serve as an inspiration to others and be able to give back your blessings to those who are in need. Today's discussion, the Almas Whitelist Screener webinar, is a very important area of discussion for Islamic principle-sensitive investors. These standards provide a framework that allow us to invest in line with certain Islamic principles. Now, back in the day, there weren't stocks and shares as we know them today. So guidelines for how to invest, in other words, for a Muslim to invest in a stock market, weren't readily available. Somewhere in the 1600s, the first modern stock trading was created in Amsterdam when the Dutch East India Company was the first publicly traded company. So to raise capital, the company decided to sell stock and pay dividends of the shares to investors. Then in 1611, the Amsterdam Stock Exchange was created. And for many years, the only trading activity on the exchange was trading shares of the Dutch East India Company. Now, fast forward almost 400 years, and modern day Islamic scholars started working on establishing a screening criteria to determine which stock companies are permissible for Muslims to invest in. Now, they recognized that this was an issue because otherwise Muslims today would be at a disadvantage when it comes to building wealth without the tools to navigate stock markets, which inevitably contain portions of interest and other non-Islamic impermissible activities. So utilizing Islamic finance principles, they came up with a set of guidelines that allow Muslims to invest today. And now when you look at it, there's been a large expansion of Islamic finance in the last 2 decades. Islamic financial assets have increased from $150 billion in the mid-90s to $1,880 billion at the end of 2015. And this growth has been driven by the development of Islamic banks, but also by the issuance of sukuk. We had a webinar recently about sukuk, and the development of Islamic investment funds that contain equities of companies that are compliant with Islamic law. According to that same report, the Islamic funds industry has grown from $28.2 billion in terms of assets under management in 2004 to $71.3 billion in 2015. But unfortunately, people have notions. Some people think that the entire stock market is permissible, the entire stock market is halal, whilst others think that the entire stock market is impermissible, the entire stock market is haram. Now, as Muslims, as believers, we should have knowledge about a matter before we simply blurt out that something is halal or haram, something is permissible or impermissible. Today, we see this trend where people, without knowledge in regards to the matter, they're very swift to arrive at conclusions. They're very swift to jump to conclusions, to quickly blurt out, oh, you know what? I think that this is haram. I think that this is halal. Our Maker, the Almighty, He clearly says in the Noble Quran, this is in Surah An-Nahl, which is the 16th chapter, verse number 116, وَلَا تَقُولُوا لِمَا تَصِفُ أَلْسِنَتُكُمُ الْكَذِبِ هَذَا حَلَالٌ وَهَذَا حَرَامٌ. And for what your tongues describe, do not lie, do not utter the lie saying that this is halal and this is haram. Why? Because this is falsehood against Allah, about Allah. If you do this, you have invented falsehood about Allah. And indeed, those who invent falsehood about Allah will not succeed. So we have to be very careful with regards to this matter. And it's imperative, it's very important that we further our knowledge in regards to these matters before arriving at a conclusion. Now, as I move forward, you have to understand that given the novelty of this issue, or given the novelty of what we're going to be discussing, there isn't one set criteria explicitly written in the Quran or the teachings of the Prophet, peace be upon him. And this is why today you have a variety of different Sharia standards that are available and applicable around the world. Now, a question may arise as to why do we need these standards? Do we really need standards? Why can't we, determine, or why can't a scholar determine as to whether a certain stock is permissible or impermissible without standards? You have to understand that navigating the Islamic investing space or the investing universe can be a bit overwhelming when you're not sure where to start and how to determine what you can and cannot invest in. And this is the exactly the reason why we need Sharia standards is to simplify the process. It is to make it easy for us to run the numbers through these filters, through these standards, and help us to make educated investment choices, investment decisions that are in line with our faith-based values. So it is important to note as we proceed that these Sharia standards are only to be used as a starting point when it comes to your investing journey, as you will see as I progress through the content. Because the compliance of a stock, the whitelist compliance of a stock can change over time. I have a dedicated slide and a section to discuss as to whether stocks are, or rather the status of a stock as to whether it's dynamic or static. So we will get to it eventually. So it is important to use this as a stepping stone, as a starting point, and always do your own research when it comes to deciding what you're supposed to invest in. The next question that can arise is, why are there different Sharia standards? Why can't we just have one standard and go with that? You have to understand that there is no single universally accepted or universally recognized Sharia standard in the world of permissible investing that is in line with the Islamic principles. Why? Because these standards, they vary depending on the markets that they're being applied in. They vary depending on their level of tolerance, their level of strictness, and the interpretation of the filters within these standards as well. Now, we at Almas, our team have decided to go about with a unique approach, and this is to add a lot of value to Islamic principle-sensitive investors. And we really hope that this approach expands the Islamic investment space and that it encourages more investors to come forward confidently. So our team at Almas, we hope to be carefully vetting every stock across not just one standard or a mixture of standards, but instead we hope to vet every stock across 5 prominent standards. And these are the 5 prominent standards that are in place. So we have number 1 right at the top, the Dow Jones Islamic Market Index. Then we have, so that's one standard. Then we have the Securities Commission Malaysia, that's the Sharia Advisory Council, SAC of Malaysia. We are having that standard that is in place as well. Then the AAOIFI standard. Then we have the Mizan Sharia Index standard. And we also have the BSE TASIS Sharia Index standard that is in place as well. So we hope to be vetting every stock, like I said, across all of these standards. And the unique way that we hope to present all of this data, because a lot of research is going into all of this, we hope to present this data, inshallah, to you as the investor in a very unique interface where you'll be able to access all of this data. And each time a stock, passes a certain standard, the pass will be denoted with a star to indicate that this stock has passed this particular standard. So before I go on to kind of discuss the standards in more detail and to kind of take you through the filters and help you to understand how these filters actually work, I'd like to give you a quick, short and summarized introduction into each of these standards, inshallah. So you have the Dow Jones right at the top, the Dow Jones Islamic Market Index. Now, this was launched in 1999 in Bahrain. It is one of the first indexes that were created for investors seeking investments in compliance with Sharia principles, Islamic principles. So the DJIM has their independent Sharia board, and they are quite popular. This particular standard is quite popular in US and the European markets. So the next standard that is in place, that is the SAC, the Sharia Advisory Council of the SC, which is the Securities Commission Malaysia. This standard screens for Sharia compliance securities that are listed on the Malaysian Stock Exchange. And its screening methodology involves a 2-tier approach. So you have two levels of screening that this particular standard goes ahead with. It consists of a business activity screen and a financial ratio benchmark. And one unique feature about this particular standard, as you will see when we go forward and compare these standards, is that this is the only methodology around the world that doesn't follow the maximum 5% impermissible revenue threshold. Instead, it ranges between 5 and 20%. So all of this will make sense as I make my way forward and explain the filters in detail. But for now, you can make a mental note of it, and inshallah, we'll try to point it out at that juncture again. So instead, like I said, it ranges between 5 and 20%, the threshold, the level of tolerance in terms of impermissible income. And this is not something that, you know, they came up, you know, out of their own pockets. It depends on the industry in which the company is in, and we'll discuss that in more detail as we progress. So the next standard that is in place is the AAOIFI standard. So it's an acronym, AAOIFI, that stands for the Accounting and Auditing Organization for Islamic Financial Institutions. So AAOIFI is a not-for-profit organization based in Bahrain. It was established in 1991, and it specializes in promoting Sharia standards for Islamic financial institutions, participants, and the overall industry. So AAOIFI works exclusively in developing accounting, auditing, governance, and ethical standards aligned with the teachings of Islam. So moving on, we have the next standard that we run our stocks across, and that's the Mizan Sharia Index. Now, this was established in 1997. The Mizan Group has a market share of over 35% of Islamic banking industry in Pakistan. So the Mizan Index, which was launched in 2009, is a Sharia screening index based on selected companies from the Karachi Stock Exchange. The last standard that we have in place is the BSE, which is the Bombay Stock Exchange, and they have partnered with Taqwa Advisory and Sharia Investment Solutions, TASIS, that's the acronym. So these two have partnered to develop the first Sharia compliant equity index in India. So it's constructed using guidelines and local expertise of a domestic India-based Sharia advisory board. So the BSE TASIS Sharia 50 index consists of the 50 largest and most liquid Sharia compliant stocks within the BSE 500. So now that I've given you a brief intro into each of these standards, I'd like to go on to now discuss the standards in more detail. In other words, we're going to break the filters down and understand them in a better detail, inshallah. But just before that, I'd like to invite Mr. Shamir Imtiaz to officially launch our website so that you will have a hands-on feeling of the website. You'll be able to access all of the data, have a look at the website, and as I explain the standards and the filters, you'll be able to go back to the website and check and see how things actually work, inshallah. That will make things a lot more interesting. So on to you, Shamir. You can go ahead with the launch. Bismillah.
Assalamu alaikum, everyone. Jazakallah, Sheikh, for that wonderful introduction. So, all right. So I'd like to take this opportunity to launch the Almas Equities website. So the website will be www.almasequities.com, and this website is now live. And I would like to take you through the explanation of the website. So here you go. This is the homepage of our new Almas Equities website. I'll just take a quick run through. You have the homepage. You know, if you'd like to open an account with us, you have the account opening tab, which will give you in detailed, very easy instructions how you can open your account with us through the CSE mobile app, and all the details are there. For existing Almas Equities customers, you can use the Trade Now button. We got some feedback as to what was the easiest way to log into the trading platform during market hours. You can just come onto our website, almasequities.com, click on the Trade Now button, and that will take you directly to the trading platform. So hope that makes things easier for everyone. And also, if you use this website on your mobile phone, that would take you directly to the A-Trade mobile app, and use the mobile app to start trading. And before I get to the whitelist screen, of course, we have the About Us. You can read more about us and the Contact Us details. So I would love to now unveil the live whitelist screener. We've taken a lot of effort, many months of research, discussions, and the team has come to this very day, and we're really excited to share with you. So I'm just going to go on to the whitelist screener. This can be accessed on the PC for the best viewing experience, as well as your mobile phone. And we will keep improving with all your suggestions going forward. So as you can see, the whitelist screener is based on the financials as at 30th September 2022, right? And we are, as Sheikh mentioned, we'll be implementing 5 global standards, each individually to one stock. So this is just a summary of the table that you can see. This is the whitelist itself. It's a very interactive table. You have all 300 companies, 297 to be exact, companies listed on this table. And you have the so let me just take you through this. You have the company column with all the companies, the symbols, the trading symbols, the sector that company falls into. We have the AAOIFI standard, the Mizan standard, the Dow Jones standard, SE Malaysia, BSE Nifty, and we have the total summary column. So what this very simply means is, let's take this example as Almas Electrical. Almas Electrical at the moment has passed through the Mizan standard. Therefore, we have awarded it 1 star under Mizan. And it has passed through the standard of SE Malaysia. So therefore, we have given it another star under SE Malaysia. So under the total and summary column, you can see 2 stars. So another easy way to use our website is come onto the search bar, and maybe we can just try searching a company that everyone is used to. Let's try Expo Lanka, for example. Just type in Expo, and straight away you can type it as the symbol, as your sector, as the company itself. So in this instance, we have Expo Lanka. And you can see here, it falls into the SE Malaysia standard and the BSE Nifty standard with a total of 2 stars. Of course, Sheikh will go into each details later on and explain. And one more interesting feature that we have is on this button here, click here, both on mobile and on the PC. Once you click onto that, our team has taken a lot of effort and created many individualized PDFs, as you can see here. So this PDF is shareable through your mobile phone or as a screenshot. This will tell you per stock how each financial ratio is laid out. So in this instance, you can see Expo Lanka as at 30th September has 2 stars. So we can see where it went out actually. So in this column, we have the AAOIFI standard. So income, we have the thresholds in the blue column, in the blue rows. So as you can see, income is all 5% on the top. Debt, 37% for Mizan, 33% for Dow Jones, 33% for SE Malaysia, less than 25% for BSE Nifty. And also one thing to note, we have mentioned here market cap assets. Sheikh will also be explaining that later on. It means it is on the basis of calculation. So AAOIFI, for example, the basis of calculation will be on the market cap, whereas Mizan and SE Malaysia will be based on the total assets of the company. So in different market conditions, we will have different standards bring in different companies into the whitelist. So as you can see here for AAOIFI, Expo Lanka is out on the liquid assets filter, but according to the BSE Nifty filter. So on that basis, you can have all the details for the particular stock. We can go back and then we can try another stock as well. You can just try let's try the code this time. Just say BFL for Bairaha Farms. Again, we can see here it is a company that has been awarded with 4 stars. AAOIFI, Mizan, Dow Jones doesn't fall in, SE Malaysia and BSE Nifty. So again, we can just click here. That'll load up the PDF. Please feel free to share around these PDFs with your friends, contacts. If you find a share that is interesting, you want to share some details, everything is in one PDF for you to share easily. So as you can see here, all 4 filters have to be in green and within the thresholds for the whitelist status to be awarded a star. So as you can see here, AAOIFI has a star, all 4 green. Mizan also has a star, all 4 filters have been in green. Dow Jones is coming out on the liquid assets filter because it is a 33% filter threshold. SE Malaysia is in all 4, all 3. BSE Nifty is in all 3 again, and then again the investment is not taken in. So on that basis, it is 4 stars. So that's one way of using the PDF feature. So just before I bring it back to Sheikh, I would like to just share one or two more features of our website, which would be really useful. Let's say you want to summarize this table in terms of companies that have been awarded 5 stars. We can just simply click on the column which is summary. It's a filtration button. So when you click on that, it goes to 0 stars. You click it once more. All the 5-star companies are shown on top. So you can see all the companies which have been awarded 5 stars. This does not mean that the company is better or worse. It is just a categorization mechanism. But you can see all the companies with 5 stars listed on top. Then we go to the companies with 4 stars, Extra, Bayraha, Blue Diamond Jewelry, and it keeps going down that way. It's quite a number. And then we come into the 3-star sections. That is another way that you can filter live. Everyone can do it yourself on the website. Another way is, let's say you want to follow only the Dow Jones, or you want to have a feel of what the Dow Jones standard has given companies. We quickly just click on the Dow Jones filter twice to bring it up to the top. And all the companies with Dow Jones having a star or passing the standard of Dow Jones is shown first. So as you keep going down, you can see here there are no stars on AAOIFI and Mizan, but on Dow Jones, we still keep having some stars all the way up to this point here. So that is another unique way of searching the companies. What if you want to search by sectors? So you can just click on the sector button, and that will arrange the sectors according to alphabetical order. So you click it once, you can see it goes from A, B, banks. So this is one more thing. So companies that are out due to core business will not be awarded any stars because they are already out on the first filter in terms of the business, the core business of the company. So you can see these companies, we have not done any awarding of stars because they're out, and we have mentioned it there, out due to core business, and there's nothing to be clicked on the side as well. So don't be worried if you can't click into some of these companies because there's no PDF to click unless it says click here. So that is more or less the whitelist screener that Almas has come up with. We really hope that it's going to be very, very useful for every one of you. You can just quickly log in on your phone, on the PC, during market hours. Just search any company that you feel like, and have a filtration and have a feel, and go in and see what the actual figures are. And also just one more thing here, I just wanted to go through this blue button here. Click here for our methodology. If you want to see a summary of all the methodology and what the calculations are based on, and you want to recap, we have one PDF document in a summary table basis that allows you to see where the region of these standards are. AAOIFI is from Bahrain, Mizan, Pakistan, Dow Jones from the US. And we have the basis of calculation for each one of these filters easily for you to have a look at. So with that, I'd like to bring it back to Sheikh Muiz to give a detailed understanding of the rest of the filters. And inshallah, we really hope that this brings a lot of value to all our customers and anyone basically wanting to have a look at the whitelist screener from Almas. Thank you very much.
Okay, so Alhamdulillah, the website was launched, the whitelist screener is launched. And I'd like to now take you through the standards in more detail, the filters in more detail, so that we can have a more clear understanding with regards to how these filters actually work. So at the very outset, if you look at companies, you can see that stock companies can be divided into 3 broad types. You have number 1, stocks of companies with permissible purposes and operations that are in line with the teachings of Islam. So these companies engage entirely in activities that are compatible with Islamic law, and they deal with Islamically permissible products and services. They do not use interest-based debt as a part of their capital structure. They do not earn interest on their deposits, and they do not invest their money in impermissible sources or ways or channels of income. So there is agreement and consensus that the shares of these companies can be owned and traded without any issues because they're completely in line. So that's category number one. Category number two, you have stocks of companies with forbidden purposes and operations. So these are companies, say, for example, that maybe deal with alcohol. They have gambling/betting operations going on. They deal in pork products. They have conventional financial services, banks, insurance, etc. Pornography, you will see a list I'll share in just a bit. So there is agreement that these companies, at the very outset itself, they'll be out due to the nature of their core business. So these companies, for a Islamic principle sensitive investor, these companies cannot be owned or traded. Now you have a third category, and this is the category in which a lot of companies fall into today. These are companies which have permissible purposes, okay, but they mix in some impermissible transactions. So they're not out due to the core business being impermissible. They have permissible purposes, but they perpetrate some impermissible transactions. So they have some impermissible transactions going on. So they may have interest deposits, for example. They may borrow using interest-bearing loans. So how does one go about navigating through companies of this nature? So there have been differing opinions put forth by scholars about this particular type. And you have scholars generally referring to principles of jurisprudence. You have legal maxims that are in place to formulate their views, as we will see in the next few slides. So before I go forward, you have to understand, my dear brothers and sisters, for a company being whitelisted, it provides access to that company. It puts that company into, or rather, it provides access to a whole new group of investors. So they now have access to the company because it's whitelisted, and should therefore increase the demand for the stocks of said whitelisted companies. Along with that benefit, the financial filters that are associated with whitelisting a company may be considered positively by stock market investors in general. And this is something that not a lot of people are aware of. On one hand, you have to see that the addition of the company into a whitelist is a signal of low indebtedness. And that's why we have the debt filter. The debt filter captures this. This is what the debt filter addresses. So this is perceived as an indicator of lower bankruptcy risk. And on the other hand, a low level of cash. This is what the liquidity filter addresses. A low level of cash can be perceived as an indicator of good corporate governance, since managers are optimally deploying the cash. It can also indicate a low level of risk, which decreases the need to retain cash reserves. So these filters, as you will see, indicate good financial health of a company, and this is something that general stock market investors will also consider positively. Moving on, if you now look at the whitelist screening process, the process consists of two primary levels of screening. You have two levels of screening. So the first level is the business sector screening, and the second screening is the financial ratio screening. So basically, for a stock to be classified as white, for it to be whitelisted, it has to pass these two levels of screening. Now, a question may arise as to whether one can invest in a stock that has passed only the first level of screening, which is the business sector screening. The answer to that is no. For a stock to be classified as white, it has to pass these two levels of screening. It would not suffice to pass only the first level of screening. So let's talk about the first level, the business sector screening. So this is the first and perhaps most obvious filter or level of screening. This addresses the core business of the company. Now, the purpose of this filter is to exclude companies with impermissible core businesses. The average Muslim or even non-Muslim in today's wonderfully diverse environment can tell you that it is impermissible for a Muslim to invest in a company whose main business is alcohol. Please note that this is not an exhaustive, all-inclusive list, but I've covered most of the areas. So if the core business involves the manufacturing of alcohol, now this is a company that's going to be out due to failing the core business or not passing the core business filter. If it's a company that's involving gambling, casinos, betting operations, it will not pass the core business filter. If it is a company primarily involved in pork and related products, it will not pass the core filter. So similarly, if you look at all these categories, let's say you have a company that's involved in adult entertainment, you have a company that's involved as a primary source of income. You have to understand that here we're talking about, see, the secondary sources of income will be addressed with the filters that are in place after this. But here we're talking about the primary source of income being from any of these impermissible categories. There you have weapons and arms, companies that are involved in the manufacturing of weapons and arms, because obviously we have the teachings of the Prophet that tell us that it is forbidden to sell weapons to those who are in a civil war. Similarly, we're not allowed to sell grapes to someone you know who will make alcohol out of it. You're not allowed to sell weapons to someone you know who's going to do something, a crime, basically, you know. So you have all these principles in place that cover all of this. The last one, for example, the trading of gold and silver on a deferred basis. For those of you who are aware, Islamic teachings outline how you're supposed to trade in gold and silver. There are guidelines. So if there is a company that's trading gold and silver on a deferred basis, then it is not permissible. And as a primary source of income, it is not permissible to invest in that company. So this is the business sector screening. Like I said, it addresses the core business of the company. Now, for this particular after this particular screening, you do have a threshold. Now, the threshold, as has been highlighted here, you have a 5% threshold, which means that there is a 5% tolerance. Now, I need you to understand this very clearly, and I'm going to try and explain this to the best of my capacity, inshallah. You have to understand that ideally, for Muslims, there should be 0% tolerance of impermissible income, right? I mean, you cannot tolerate impermissible income. You only have to work and strive towards pure and lawful income. So there's absolutely no tolerance. But in today's context, in today's complex landscape, if we were to have a 0% threshold, a 0% level of tolerance, that would drastically shrink the Islamic investing space. It would shrink the Islamic investing universe. Because like I said earlier on, most companies tend to have both permissible and impermissible lines of businesses. So if, and this is why scholars have come to a certain agreement that prohibiting participation in such companies would inflict harm and hardship on the Muslim investor. So there's a legal maxim that states that harm must be eliminated. And another legal maxim states that hardship begets ease. Al-mashaqqatu tajlibu taysir. Hardship begets ease. We have another legal maxim that is in place, al-darurat tubihul mahdurat. Now, obviously, all these maxims are interpreted in different ways, but I'm just giving you a summary of the maxims that scholars tend to fall back onto in arriving at guidelines for all these filters. So the last maxim that I mentioned, al-darurat tubihul mahdurat, which is translated as necessities make forbidden things permissible. So as you can see here, because it's a very complex landscape and most companies today have some form of impermissible income, that is why this threshold has been allowed. But now a question can arise, why a 5% threshold? This 5% threshold, because obviously you don't have any explicit teachings from the Quran, explicit teachings of the Prophet. The Quran does not tell us anywhere that 5% is allowed. The teachings of the Prophet ﷺ don't tell us that 5% is allowed, because like I said earlier on, ideally it has to be 0%. So this 5% threshold is ijtihadi, which means that it stems from the legal reasoning of scholars. And this can differ from scholar to scholar, and it can also differ from standard to standard, as we will see, inshallah. Remember, I said at the beginning, I think you'll recall now, that the Malaysian standard has a slightly more flexible approach in regards to this particular threshold. Whilst all the other standards stop at 5%, the Malaysian standard goes up to 20% with regards to certain industries. Not all industries, please mark my words, not all industries. Certain industries are allowed up to a 20%. Now, coming back to the 5% threshold to understand this better, the idea behind this legal reasoning of scholars is that they fall back onto a legal maxim known as al-yasiru ma'foon an. A little or something trivial is forgiven, is excused. So something little, something trivial is forgiven or excused. So if you have a company that is 95% compliant, but 5% impermissible. So 95% it's compliant, it's permissible. 5% impermissible. It would pass this particular threshold as per the legal reasoning of the scholars behind these standards. Now, I want to make this clear again. We're not talking about the core business here. So let me give you an example. Let's say there was somebody, starts up a grocery store and he's selling only permissible items. So someone comes to him and tells him, you know what, why don't you now open up some branches? Why don't you relocate to more central locations? Why don't you perhaps maybe open like a mini mart, like a small supermarket or whatever it is next to a fuel station so that there's more traffic, people come and they'll buy more of your products. So eventually he starts to expand and diversify. Now, when he starts diversifying, his core business, which is selling groceries, so long as he's not selling anything impermissible, is permissible. It's clear. It's in the green. No issues. But now, in the process of expanding, unfortunately, he goes down a slippery slope. Why? Because people tell him, you know what, the crowd that comes, perhaps they want some cigarettes, maybe. So if you are to sell tobacco products, maybe they'll go on to buy other things. Some of your other products might move. People come up with all kinds of ideas, right? So now what he does is starts to introduce tobacco and cigarettes and whatnot. Now this, if he is now making this his primary source of income, it's problematic. But if it is a secondary source of income, 95% of his sales are all permissible products, but he has 5% of sales coming from impermissible, 5 or less than 5, maybe 1%, 2%, 3%, 4%, 5% of impermissible products. The scholars behind these standards fall back onto this maxim where they say that a little or something trivial is forgiven or excused. Another question could arise. You may ask me, but then Sheikh, why 5%? Yes, it should be ideally 0%, but why couldn't the standards fall back onto maybe 1%, 2%, 3%? Why did they go up to 5% and allow 5%? Now, there are scholars who explain that this ratio, 5%, is related to segment reporting in accounting standards. For a segment of a business to be considered quote unquote material and be reported separately. Now, this is as per the accounting standards. there, you know, online you can read on these papers that have been written. There's this paper, Materiality Guidance of Major Public Accounting Firms. So that paper states that out of the 8 largest major public accounting firms, 6 firms suggest or require the use of 5% of income before taxes, whilst 1 firm goes up to 5 to 10%. So basically, the firm states that in our guidance or in our experience, it appears that the SEC staff, their stock exchange staff, generally consider amounts over 5% of pre-tax income from continuing operations to be material, to be reported. So it kind of falls back onto this scientific accounting standard that 5% is considered something material, whilst 1, 2, 3, 4 is not considered material. 5 is considered material. So this is the percentage that they fall back onto, these standards fall back onto when it comes to impermissible income. Now, if you look at this slide, you'll see that we have an impermissible income filter. So remember, we had the core business filter, we passed that, we discussed that. Now you have all these filters that are in place. So once a company passes the core business filter, so the core business is permissible. It's involved in businesses that are not problematic in its core sense. Now we have to check as to whether it has any impermissible income coming in. So here you have a 5% threshold. As you can see here, the standards that we're following, so the Dow Jones, it has to be less than 5%. SAC Malaysia ranges between 5 to 20%, depending on the industry in which the company is in. AAOIFI less than 5%, Mizan less than 5%, BSE TASIS less than 5%. Now, the general principle that we fall back onto with regards to this whole concept of segregating or separating impermissible earnings from permissible earnings is based on an incident that took place during the time of the Prophet, peace be upon him. This incident, this narration is recorded in the book of Imam al-Bukhari, rahimahullah. The Prophet was once asked regarding butter. So this is the incident. Basically, there was someone who had some butter, and because it was a very cold season in Medina, the butter had solidified, because in cold, the butter solidifies, right? I mean, generally in our context, we put it in the refrigerator and it solidifies, but in cold environments, even without putting it into the refrigerator, it solidifies outside. So this individual had placed it outside, the butter had solidified, he goes to sleep. And then in the morning when he wakes up, he comes to take some butter and he finds out that a mouse or a rat had fallen into that bucket or that vat of butter. So he asks the Prophet in regards to this vat, this bucket of butter, what am I to do, O Messenger of Allah? A rat or a mouse has fallen into it. Do I discard the entire thing? What am I to do? The Prophet, peace be upon him, at that juncture advised him, Alquha wa ma hawlaha. The Prophet tells him, take out the mouse, take out the rat, and throw away the butter around it as well, and use the rest. So you have a vat of butter, it's solidified butter. The rat has fallen, or the mouse has fallen on top of the butter. So the Prophet's instructions were to take the rat out and even to scoop out the butter around it, and the rest of it can be utilized. So from this, scholars deduce that you have pure earnings, you have a small percentage of impermissible earnings, which can be segregated. And today with financials and access to all these numbers, you can segregate the impermissible earnings. You're supposed to remove it and segregate your earnings accordingly. So I hope this particular filter is clear. Before we move on, there's another question that could come up as to whether this 5% threshold includes interest income. You have to understand that this threshold only looks at operating non-permissible incomes. So for example, if a company is involved in selling meat, okay, it's selling meat, including pork, then the income from selling meat is operating in nature. Just like even the example that I gave you earlier on of the grocery store selling cigarettes. That is the operating income of that store. Similarly, the company that's involved in selling meat products, they have a line of pork products as well. So the income from selling meat in general is operating in nature. Okay. So now this company, if it's entirely selling pork, then it is out due to core business. But if it is selling all products, meat products, and then they have a line of pork products as well, now we will look as to whether this impermissible faction or this impermissible segment of this company is below the 5% threshold. If it is more than 5%, then it is disqualified. But if it is less than 5%, then it passes the threshold. Similarly, if a company is selling furniture, okay, and gets interest income from its, you have to understand this properly. The example of a company selling meat, including a pork range of products, this would be considered operating income for this company. So we would look at it as per the threshold discussed. On the other hand, if you have a company selling furniture, now this is the operating business of the company, selling furniture, but the company has cash, it has liquid cash. So what does the company do? It goes and deposits the cash in a bank and earns interest. Now, this interest income that this company, this furniture company, is earning from the bank is non-operating in nature. I think you would agree, right? So this is non-operating. So this will not be included in this threshold. Why? Because we have a separate filter, a non-compliant investment filter, which will capture that. So this filter, let me make it very clear, this filter will only address operating income. I hope it's clear. So now that we're done with the core business filter and the filter that's attached to it, which is the 5% filter, now we move on to the financial ratio screening. So here you have 3 filters that a company has to pass. After it passes the core filter, let's say if it has impermissible segments, then there's a 5% threshold. It passes that as well. Now it needs to pass these 3 filters in the financial ratio screening. Now, what are these filters? You have the debt filter, you have the non-compliant investments filter, and you have the liquidity filter. Let's look at these filters very quickly. So if you look at the debt filter, you can see the standards. Each standard has a slightly different interpretation or different numbers, if you will, different percentages of each in terms of the application of this filter. So let me quickly firstly explain the filter. The purpose of this filter is to control the involvement of the company in paying interest. So it's a debt compliance ratio. So here only interest-bearing debt is considered. Islamic debt is excluded. If it's an Islamic product, then it is excluded. Interest-bearing debt is considered. And you have to bear in mind that this is the total entire debt value. It is not the interest payment component. It is the entire debt value to either the market cap or total assets, because you will see some standards use the total assets, some standards use the market cap. The denominator is either the market cap or total assets. But the total entire debt value of the company is taken, not the interest expense. Obviously, when you look at it in the sense of the interest payment or the interest expense, it is way lower. So before we compare the standards, you may also be thinking why some standards use total assets and why some use the market cap. So there is this discussion as to, why can't we go with total assets, or why can't we go with market cap, total assets versus market cap? So what is market cap? The market cap is basically the total number of shares of the company into the price of the share. So this question comes up a lot. Why? Because some people are of the view that the total assets reflect the true value of the company, right? But then there are others who would argue that in today's modern landscape, you have certain things, certain elements, if you will, that the total assets, the book value, does not capture. Like the goodwill of a company. Total assets, there's no way for total assets to capture the goodwill of a company, the brand value of a company, the certain intellectual properties of the company, trademarks, copyrights, patents, and then you have certain other intangibles that the total assets is not able to capture. Similarly, if you look at certain sectors and certain industries, such as logistics, technology, biotech, healthcare, all these sectors, total assets don't really give you the actual value of the company. Take, for example, a company like Uber. Uber doesn't necessarily own any cars. It's quote unquote a transportation company, but it doesn't own any cars. It's all outsourced, basically. Take Airbnb. They are into the rental business, but they don't own any homes. So as you can see, these models, market cap is only able to capture the real value of business models of this nature. So this is why some of the standards, including AAOIFI, select market cap due to it being able to capture all of this. And the scholars behind these standards are also of the view that market cap is more sensitive to debt incurring events such as credit agency downgrades. They are of the view that it is more transparent and that it is less vulnerable to manipulation by the management itself than total assets when valuing a company, because total assets can be manipulated by the management. Market cap is less vulnerable to manipulation. But now some would argue that, market cap can be manipulated as well. In smaller setups, it's possible. In smaller markets, maybe, in smaller companies, possible. But when talking about more developed, more mature markets, bigger companies, take, for example, Apple, to think of manipulating Apple's stock, it's almost impossible because, it's a big share, so many shares, and, you have a lot of intricacies going on. Similarly, you have stock market regulations that are becoming more and more stringent with regards to manipulations of this nature. So at the end of the day, what we have to understand, my dear brothers and sisters, is that market cap and total assets are both acceptable denominators. And all these globally well-recognized standards / screenings use either market cap or total assets. Now, the advantage for you through our approach here at Almas is that you're going to be able to look at data captured across all these standards, because you will see, inshallah, as the months go past, depending on the situation, depending on the company, sometimes market, when you, for example, when you are in a bull market, going with market cap brings in more companies into the whitelist. Whilst on the other hand, in a bear market, it could result in more companies going out of the whitelist. So here, because you have access to multiple standards, it's going to help you make a very educated decision. You have the choice of looking at the whitelist as per total assets of that particular company, and you can also compare it to the market cap of that particular company at that juncture during that period of the market. So it's going to be a lot of value added to your investment decision, inshallah. So now let's quickly compare the standards. You can see Dow Jones right at the top. They look at interest-bearing borrowings across a trailing 24-month average market cap, and this needs to be less than 33%. I'm going to explain that in just a bit, but we'll run through all of it very quickly. SAC Malaysia, they have interest-bearing borrowings. They look at that. The denominator is total assets, and it needs to be less than 33%. AAOIFI, interest-bearing borrowings. denominator market cap, less than 30%. Mizan, interest-bearing borrowings, denominator total assets, book value, less than 37%. BSC, interest-bearing borrowings, denominator total assets of the company, it needs to be less than 25%. Now this percentage, this is the tolerance. So all these standards are basically allowing. If you take AAOIFI, for example, it's 30%. The tolerance is 30%. You take SAC Malaysia, 33%. So you have anywhere from 25% to a maximum of 37% being allowed across all these standards. So if we were to look at 33%, you might ask, why 33%? Now over there it was 5%. Now here, why 33%? So it's 1/3 basically, right? So you might be thinking, why not 5%? The maxim that we fell back onto with regards to 5% is that al-yasiru ma'fuun an. A little is forgiven and considered negligible. Now there you have to understand, there with 5%, we're talking about operating income. Operating income. Now this is a secondary aspect. It is not related to, you will see this, and even with the non-compliant investments filter, which is the next filter after this, it is the same 1/3 ratio that is applied, because I mean there's a little more flexibility here put forth by the scholars, whilst over there with the 5% filter they were very somewhat rigid and strict, because there we're talking about operating income. So here we're looking at secondary activities of the company, and they fall back onto the legal maxim, athuluthu kathir. 1/3 is a lot. 1/3 is excessive. So you shouldn't exceed 1/3. And this is based on a very famous incident that took place again during the time of the Prophet, peace be upon him. This hadith, this narration is also recorded in the book of Imam al-Bukhari, rahimahullah. Sa'ad ibn Abi Waqqas, a famous companion of the Prophet, he narrates that I became seriously ill. I fell ill in Mecca, and the Prophet, peace be upon him, came to visit me. So I said, O Messenger of Allah, I'm going to be, narrating the incident in my own words. I have wealth. I'm going to be leaving behind a fortune, but my only heir, my only inheritor is a daughter. So shall I write as a last will 2/3 of my property to be spent in charity and leave 1/3 for my daughter? Can I write 2/3 of my property, of my estate, to charity and leave 1/3 for my daughter? The Prophet replied in the negative. He said, no. Then the companion, Sa'ad ibn Abi Waqqas, he asks, shall I leave half for charity? Shall I write half for charity and half for my daughter? The Prophet said, no. Now he asks, so if that is the case, O Messenger of Allah, shall I write 1/3 in charity and leave 2/3 for my daughter? The Prophet said, athuluth. 1/3, and then the Prophet went on to say, athuluthu kathir, and 1/3 is a lot, and 1/3 is a lot. So that is the maxim that the scholars fall back onto. It's deduced from this narration that 1/3 is excessive. Now, you have to understand that this, you might be thinking this is, the context is different, but there are deduction tools in terms of how you arrive at these maxims. And this particular maxim, this particular statement of the Prophet has been used in several unrelated Islamic legal issues. In the Maliki school of thought, in the Hanbali school of thought, even in the Hanafi school of thought, if I'm not mistaken, it is used. Imam Ahmad ibn Hanbal from the Hanbali the school states that this concept of athuluthu kathir has been applied in 17 different issues, because 1/3 is considered excessive. It's considered a lot, and less than 1/3 is considered not excessive. So the principle applied in understanding this statement of the Prophet is al-ibratu bi-umum al-lafz la bi khusus al-sabab. So this concept does not have to solely apply in the context of the last will. It does not have to. Rather, it can be used in a more general sense as well. So this is the principle that all these standards fall back onto, where they consider 1/3 to be a lot. Now, when you look at AAOIFI, they restrict themselves to 30%. Now, this is to keep some distance from the 1/3 and stay below it, a buffer, basically, to stay below the 1/3, because if you go precisely 1/3, it's 33.333%, right? So to keep a buffer and to stay away from it, 30% has been selected by certain standards. All right, let's move to the next one. Now you have non-compliant investment filter. Now remember, I was talking about this when we spoke about the 5% threshold. I told you that interest is not captured by that filter, it's captured by this filter. Why? Remember the answer. With the 5% filter, it captures and addresses only operating income. Here, we're looking at secondary income, a company that's manufacturing tires. They go park their money in the bank and they're earning interest now. Now, that's not their operating income, because manufacturing and selling tires is their operating business. But because they've got a lot of cash, they go and park it in the bank and start earning interest on it. Now, that's going to be captured over here. So you have the non-compliant investment filter. So here, the purpose of this filter is to control interest and other types of impermissible secondary income. So it's not only interest, by the way. As you will see, some of the standards have more broader definitions of it. Now, if you look at Mizan, it states non-compliant investment. So it's not only interest. Let's say a company that's involved in a primary core business that is permissible goes and invests in a secondary business that is not compliant. Now, that also would be captured over here. So like I said, it's to control interest and other types of impermissible secondary income. Now, if you look at the standards, DJIM, that is Dow Jones, they factor cash plus interest-bearing investments. Now, this is investments that are accruing interest, okay? The denominator is basically a trailing 24-month. Oh, and by the way, with regards to the trailing 24-month, even in the earlier filter, you saw trailing, right? So why a trailing or an average or a moving market cap is used in certain standards is, again, to avoid price fluctuation. And this is why a trailing average, a trailing market cap is used. So here you see Dow Jones using cash plus interest-bearing investments, the denominator being a trailing 24-month average market cap, and that needs to be less than 33%. Again, the same 1/3 maxim is used here. 1/3 is a lot. Then you have SAC Malaysia that says that cash denominator total assets must be less than 33%. Now, when Malaysia says cash, they go on to explain and expound by saying that cash includes cash placed in conventional accounts and conventional financial instruments, whereas cash placed in Islamic accounts and Islamic instruments is excluded from this particular calculation, from this filter. So you have AAOIFI that also looks at interest-bearing investments, denominator being market cap, it should be less than 30%. Mizan looks at non-compliant, and this is what I was saying earlier on. As you can see, with AAOIFI, their language is in relation to banks and interest-bearing investments, but Mizan, the scope is broader. They say non-compliant investments. So it's not only interest-bearing investments, other investments that are impermissible are also factored into this. The denominator is a total asset and it needs to be less than 33%. BSC is silent with regards to this particular filter. We move on to the next filter, which is the liquidity filter. This is basically the last filter. Now, as you can see here, let me explain the purpose of this filter. The purpose of this filter is to ensure a low level of liquidity. Now, like I said at the very beginning, a low level of cash can be perceived as a healthy indicator, a healthy sign, a good indicator of diligent corporate governance, because it indicates that managers are optimally deploying the cash in the company. And it can also indicate a low level of risk, which decreases the need to retain cash reserves. So here, if a company has cash in hand, all cash is considered, or it has liquid assets, equity investments, All of this is factored into this particular filter. And as you can see, Dow Jones, they look at AR basically stands for accounts receivables. So they're not factoring cash in there. They only factor accounts receivables. Why? Because if you look at the previous filter, they're factoring cash there, okay, in the non-compliant investment filter. So cash accruing interest or cash sitting in a bank is factored there. Malaysia is also factoring it in the non-compliant investment filter. So here, Dow Jones factors in the liquidity filter accounts receivables. The denominator is a trailing 24-month average market cap. It needs to be less than 33%. SSC Malaysia does not factor it in here because, like I said earlier on, it factors it in the previous filter. AAOIFI looks at liquid assets, denominator being total assets has to be less than 70%. In other words, illiquid assets has to be 30%. Why? Because again, the 1/3 rule is applied here as well. Athuluthu kathir, 1/3 is a lot. So if you have 1/3 of illiquid assets, it is considered excessive and a lot, substantial basically. So Mizan also factors liquid assets, denominator being total assets, but their filter is at 75%. It should be less than 75%. So there's a little more flexibility with Mizan. And BSC is the most flexible of them all, where they factor accounts receivables plus cash on top of total assets. It has to be less than 90%. So this is the liquidity filter. Now, why is this filter in place? My dear brothers and sisters, you have to understand that if a company has more than 1/3, then the company has, in other words, if the company has more than these percentages, less than 1/3, if you take AAOIFI, for example, if the company has more than 70%, then it's crossing that 1/3 threshold, at least 1/3 of illiquid assets. It has got 2/3, 70+% of liquidity, then the company has excessive cash. And then you have certain rulings that come into play. To be more specific, the rulings of SARF come into play. What are the rulings of SARF? The rulings of SARF are basically the cash to cash ruling. So now if a company has so much of liquid cash, it's basically looked at as trading cash to cash. And the Islamic rulings with regards to cash or gold for gold, it has to be on the spot, and there can't be, it should be only on par, no premium or no discount. But obviously in the market, you don't buy and sell shares on par. There's always a premium or a discount involved. So that premium or discount, because of the fact that the company is so liquid and has so much of cash, it is akin to trading in cash to cash. That premium or discount is riba. That premium or discount is considered as interest, as a form of interest, as a form of riba. I hope that's clear as well with regards to the liquidity filter. Now we have two more areas to discuss, namely being, let me just get to that slide. Is the status of a whitelisted stock dynamic or static? So I'm not going to be discussing this immediately because we have another program on our itinerary right now, but I'm just going to give you a run through the content. So you have this area where we're going to be discussing what happens, basically, is the status of a whitelisted stock dynamic or static, in the sense if a stock is whitelisted, will it remain whitelisted throughout, or is its status dynamic? Will it change, or can it change? Can it be reclassified as being no more whitelisted? And if that were to happen, what am I to do as a Islamic principle sensitive investor? So that's one area of discussion. And we also have another small area to discuss with regards to purification, to purify our stocks, because we have impermissible elements like we just discussed. There are thresholds, right? So each of these thresholds allow a certain amount of impermissible elements to come in. So there is a mandatory need to purify our stock holdings, and we will discuss that in more detail as well, inshallah. So just before that, now that we have discussed all these filters in detail, it's going to be very interesting to see a real world application of these filters It'll give us a lot of insight to see how the workings are done and how a company is actually run through the filters, how are the numbers all calculated, and how are these nitty-gritty things done. And for that, inshallah ta'ala, I'd like to invite Mr. Yahya on board to run us through a few examples, a few calculations, inshallah. On to you, Mr. Yahya.
Jazakallah, Sheikh.
Barakallah fikum.
Assalamu alaikum warahmatullahi wabarakatuh. I would like to take you all through certain calculation of 3 different companies which are having stars, and actually we have chosen irrespective of the company, I just chosen based on the stars these companies qualified. Now, first of all, I'd like to take through Agalavatta plantation. We know the core business is permissible. Agalavatta, they are into plantation. And I would like to take through AOIFI first. Now, AOIFI standard, as Sheikh Muiz explained, they go by market capitalization of the company. But however, when they clarify on the impermissible income part, all the standards, AOIFI, Mizan, Dow Jones, SC Malaysia, BSE, all of them use the total income as the denominator. But there is one thing specific with Dow Jones. Dow Jones doesn't consider interest-bearing income as impermissible. So they consider always, when the calculations are done, they consider impermissible income minus interest-bearing income. So therefore, in terms of Agalavatta does have some interest-bearing income of 57,000 against a 4 billion total income. So therefore, the impermissible income value is very, very small. It's minute, 0.01%. Then interest-bearing borrowings against market capitalization, because AOIFI use market capitalization. Agalavatta has a 765 million impermissible interest-bearing borrowings against a 5 billion market cap. Again, Agalavatta also has interest-bearing investments of 8 million against the 5 billion market capitalization. In terms of liquidity ratio, Agalavatta has 151 million as liquid assets compared to the total assets of 8 billion. So therefore, under AOIFI, Agalavatta qualifies, all the boxes are ticked. So therefore, a star is being awarded. Now, when you take Mizan, as I explained, the impermissible income part for Mizan, SC Malaysia and BSE all are same, because their denominators are considered as the total income, and the numerators will be the impermissible income component. Again, when we go through the impermissible income, usually we go through the P&L. In the P&L, the line item will be finance income, but sometimes we are unable to just use the value stated there, because we have to go back to the cash flow statement and see what are the how the breakdown has come in, because sometimes this finance income also includes exchange income, and some other income as well. Now, in terms of interest-bearing borrowings, 765 million is the component throughout for all the screening criteria. So there's no change in the numerator for AOIFI, Mizan, Dow Jones, SC Malaysia, and BSE. But the denominators are different. Mizan and SC Malaysia, as well as Nifty, that is the BSE Nifty India, takes total assets as their denominator against this interest-bearing component. But AOIFI, as I explained, it has taken market cap, and Dow Jones takes 24-month trailing average market capitalization. The same thing is applicable under interest-bearing investments. This company has interest-bearing. It has made interest-bearing investments of around 8 million rupees against a 5 billion market cap, or a total 8 billion total assets, which is under Mizan and SC Malaysia. BSE Nifty doesn't consider that component. When it comes to liquid asset, other than Dow Jones, other 3 use total assets. Dow Jones uses the 24-month market trailing, and therefore under all the categories, the companies qualifies and gets the star. Now, this is a unique company which has the market capitalization, the 24-month market cap, the trailing average market capitalization, as well as the total assets are somewhere a bit closer. Therefore, the numbers are not varying much. In the next example, ACL Cables. Now, ACL Cable is a 3-star company which has qualified under Mizan and SC Malaysia and BSE Nifty. Now, if you see again on the impermissible income component, there's no dispute under AOFI, Mizan, SC Malaysia and BSE. The impermissible income is less than 5%. But Dow Jones, as usual, they don't consider interest component as an impermissible component. Therefore, that stands 0. When it comes to under AOFI, the interest-bearing borrowings, under market capitalization, it has a 16 billion market cap against an interest-bearing component of 3 billion. So this ratio stands at 23.2%, whilst Dow Jones has something very similar, 15 billion, a 24-month average market cap against the same interest-bearing component. But interestingly, the total assets of these companies almost double. It has around 33 billion total assets against the same interest-bearing component. Therefore, the ratios compared to Dow Jones and AOFI, these ratios are almost half of it. Now, the interest-bearing investments of ACL Cables lies around 7.7 billion against the same 16 billion market cap. So therefore, the ratio exceeds 33%, and it is being marked now. It's exceeding the ratio. Therefore, under this, due to this category, a star is not being awarded. Even though under the liquid asset, it's still qualified because it is under 70%. Now, if you see Mizan and SC Malaysia as well as BSE, since they are total assets are almost double of ACL Cables market capitalization. So therefore, their ratio stands 23%, 23, and BSE Nifty doesn't consider this value. So therefore, under Mizan and SC Malaysia, under interest-bearing investments, the tick is they get a star. And addition to that, even the liquidity ratio is almost, other than Dow Jones, other three are using the same methodology. Therefore, Mizan qualifies under even liquidity ratio as well as BSE Nifty. But Dow Jones, since they have compared to their total assets, it's almost half of their total assets, the 24-month trailing balance average market cap. Therefore, it exceeds the 33%, and a star is not been awarded to ACL Cables. Therefore, the ACL Cables is being recognized under 3-star category, as they have been awarded 3 stars under AOFI, under Mizan, SC Malaysia, and BSE Nifty. HECA PLC, again, a business where the core is considered as permissible. Now, HECA has invested into large amounts, or they have interest components, and the interest components are exceeding 5%. Now, therefore, they don't qualify under either AOFI, that means under total impermissible income, under total income under AOFI, because the value is 7.25%. Likewise, Mizan also, because the same denominator and numerators are being used across the board other than Dow Jones. Since Dow Jones doesn't consider this amount as a interest component, as an impermissible component, so they qualify, they get a tick under that category of impermissible income. Likewise, under interest-bearing borrowings against market capitalization, HECA exceeds 78%, and they are not being definitely they won't qualify. So, addition to having an impermissible income of above 5%, they also have an interest-bearing borrowing component of 78%, as well as interest-bearing investments of 42%. Even though their liquidity ratio qualifies in, since from 3 fronts they have exceed their ratios, they won't qualify. Under Mizan, even though HECAB has a larger asset portfolio of 49 billion, since and they qualified under interest-bearing borrowings, interest-bearing investments, and liquidity, since their impermissible income component is over 5%, they won't be awarded with the star. The same case applies with SC Malaysia as well as BSE Nifty. In terms of SC Malaysia, the only component which is missing is the impermissible income component because they are exceeding 5%. But in terms of BSE Nifty, they are exceeding on the impermissible as well as the interest-bearing component of 25%. Therefore, HACAB is being only awarded under the Dow Jones category, and they have been only awarded 1 star. Over to you, Sheikh.
SubhanAllah, you really need a good head to, understand all the numbers. Jazakumullah khair, brother Yahya, for, crunching all the numbers. He put in a lot of hard work to run the stocks through all these standards. Jazakumullah khair. All right, to proceed with our discussion, now that we've seen how is my video not visible? How is it now, Shamir?
Not yet check noise.
Okay, let me just try that again. How is it now?
Not yet.
Let me just stop sharing. I'll try again. Doctor, is my camera on now?
Yes, the camera is on, but the PowerPoint presentation is not visible.
Okay, let me share the presentation. How about now?
Yes, all good. We can see both.
Okay. All right. Okay, so to continue our discussion, is the status of a whitelisted stock dynamic or static? So what do we mean when we say dynamic or static? Static is it fixed? Dynamic is it could it change? The answer to this question is that the status of a stock, a whitelisted stock, is dynamic, and it could change because of a number of factors. It could change because of a change in the market cap of the company. If a company's market cap is increasing, depending on the standard, if it's a standard that takes the market cap as a denominator, then if a company's market cap is increasing, it will help bring the financial ratios, the filters of those ratios within the permissible threshold. And the inverse will also be true. A compliant stock may turn non-compliant if its market cap is falling, which leads to it failing one or more of the financial ratios that we discussed earlier on. Another factor that results in a stock status changing is new financial numbers, either quarterly or annually. So a change in the fundamental financial numbers of the company based on either the quarterly or annually results can result in the company not passing one of the, or the company breaching one of the compliance thresholds. So as you can see, there are factors that result in a stock being reclassified. So it can be classified as a white stock, and down the line it can be reclassified as non-compliant. So the question that arises for the investor, what do I do if a whitelisted stock is reclassified as non-compliant? And I want you all to listen to me very attentively. These standards have differing views on this matter. Now, there are two main approaches, and I want to run you through these two main approaches. The first approach is divest immediately. This is the first approach. The second approach permits holding the investment for a period of 90 days to see if the stock becomes compliant again, because it's been reclassified as non-compliant. But again, due to the same reasons that we mentioned earlier on, change in the market cap, new financial numbers coming in, certain intricacies within the company, like it could be a rights issue, it could be so many factors, obviously there are complex factors in the market. So the scholars of the second approach allow holding the investment for a period of 90 days to see if it becomes compliant. So basically, you have 90 days to exit the stock. First approach, divest immediately. Second approach, you have 90 days to exit. Some standards allow 30 days, some allow 60 days, and some allow 90 days. Now, again, I need to put forth a disclaimer. These are personal ijtihadi. Ijtihadi means legal reasoning of scholars. These are legal reasonings of scholars, personal legal reasonings of scholars. And Wallahu alam, Allah knows best. Even I do not have any verses of the Quran or the Hadith to bring at this point and illustrate or to fall back onto for these 30, 60, and 90-day periods. But nonetheless, because of it being a modern day issue, and it is something that we have to deal with in the modern day landscape of the stock market, there are scholars who allow the second approach as well. And at the end of the day, as an investor, it is up to you to decide as to whether you want to go with approach 1 or approach 2. Now, to shed more detail, I'd like to explain approach 2 a little more, inshallah. So now we mentioned that there is a grace period of 90 days. Now, during this grace period, all gains that can be capital gains, trading gains, and dividends from the date the stock. Okay, let me reiterate. If you choose to go with approach 2, I'd like to shed more light in that regard. I'd like to explain approach 2 a little more based on what the scholars have arrived at. Okay, so if you choose to go with approach 2, because approach 1 is pretty straightforward, right? Divest immediately. Approach 2, during the grace period, all gains, capital gains, trading gains, and dividends from the date the stock turns non-compliant till the 90th day or the earlier date of sale of the stock can be retained as permissible income. Please note that the usual purification process of dividends and other, the usual purification process, depending on which purification process or method you go ahead, is applicable. That is applicable with regards to compliance stocks and stocks that have been reclassified as well. But during the period, all gains can be considered permissible income. Now, if after that period, after 90 days, the stock is still not Sharia compliant, if it is still not, we cannot bring it into the whitelist, then you must dissolve your position as per approach 2. And after the end of the grace period, after the end of 90 days, all gains, capital gain, trading, or dividends must be fully purified. And in summary, fully purified in the sense it has to be given out in charity, which we will discuss in more detail when we come to the purification section. Now, I'd like to run you through a few scenarios when it comes to approach 2 to give you more clarity, inshallah ta'ala. So if you look at this now, you'll, I think, have a better picture. So you have an investor who buys XYZ stock on the 1st of December, okay, 2022, for the price of 100 rupees, all right? Then on the 1st of January, 2023, the stock turns non-compliant. So it is reclassified as being non-compliant at the point when the stock is 150 rupees. Now, you can see here from the point it turns non-compliant, you have a 90-day grace period to exit the stock. And because you will see a few more scenarios, just make a mental note here, at the end of the grace period, it ends up being 400 rupees, all right? So let's say now you bought it at 100 rupees. It's 150 at the point of it turning non-compliant. So let's look at scenario 1 now that we have an understanding of this. So scenario 1, okay, this is to sell or exit before the grace period ends. So you buy the stock at 100 rupees on the 1st of December, 2022. 150 rupees at the point it turns non-compliant on the 1st of January 2023, it's 150 rupees. And you are selling it on the 1st of February. So if you factor 90 days, the grace period is 1st of April 2023. But you as an investor, you sell the XYZ stock on the 1st of February 2023 for 250 rupees. So your permissible gain is 250 rupees minus your 100 rupee investment. You have a gain of 150 rupees as capital gain. This can be retained as permissible income as per approach number 2, and there is no need to purify this amount. Why? Because the stock was sold before the expiry date of the grace period. So this is scenario number 1. Scenario number 2. So scenario number 1 was to sell or exit before the grace period ends. Scenario number 2 is to sell or exit after the grace period ends. So again, if you look at the chart now, you can see the mouse cursor, right? So you have an individual buying XYZ stock on the 1st of December 2022 for 100 rupees. On the 1st of January 2023, it turns non-compliant and it's 150 rupees, okay? The 90-day grace period ends here on the 1st of April 2023 at 400 rupees. This investor does not sell here. He passes the 90-day grace period and he sells the stock on the 1st of June 2023. I think there's a typo here. It's actually 2023. When the price of the stock was 500 rupees. Okay. So now, what is the permissible income as per approach 2 and what is the tainted income as per approach 2? So permissible income is, so this individual can retain, as you can see here, 400 minus 100, that is his cost. So he can retain 300 rupees as his permissible gain. Why? Because all gains till the grace period ends will be considered permissible as per approach 2. Okay, I hope that's clear. So the income that is to be purified is this part after the grace period has ended. So that is 500 minus 400. 400 was the price on the 90th day. So that equals 100 rupees that has to be donated to charity, as it is a gain that is accrued after the end of the grace period. I hope that's clear. Moving on to scenario 3. Now here, this is to sell or exit after the grace period ends and you are at a loss. So the question is, at the end of the grace period, if I'm at a loss, what am I to do? Okay, so the grace period, you basically have waited the 90 days and you're still at a loss. Now, what are you supposed to do? There are 2 approaches. Number 1, highly recommended to sell at the end of the grace period, because from an Islamic perspective, you become a partner when you own the share. So if you hold the share beyond the grace period, you are considered a partner in a non-permissible business. You have got a leeway, you've got a grace period to exit. And if you continue to hold the share after the grace period as well, you are now considered a partner in a non-permissible business. Why? Because the stock is not compliant. So this is approach number 1, to sell at the end of the grace period. But you are at a loss, remember. So the question is, I'm at a loss, what am I supposed to do? So approach number 1, sell at the end of the grace period. Approach number 2, hold and sell when you recover your initial investment, the principal that you put in. If you are at a loss, then you hold and you sell when you recover your initial investment. Anything above that has to be purified, given out in charity as per approach number 2. One more question in regards to this before I move forward. What am I to do if I am already invested in a non-compliant stock? Maybe this is the first time you're watching a webinar of this nature and you're learning about the whitelist and the screening filters and all of this. And right now you take a look at your portfolio and you may be having, or you may be already invested in non-compliant stocks. So the question may immediately arise, what do I do now? I'm already invested in non-compliant stocks. You may go onto our website, you may check all the stocks and shares, and you see that, I am already invested in a non-compliant stock. So what am I supposed to do? So at this juncture, what you're supposed to do is that, again, as per approach 2, if in profit, you may sell. By the way, these are all, the information that we are putting out here. At the end of the day, the ball is in your court and you have to take the call. If you're in profit, you can sell and you may donate the profit to charity. If you are under loss, you may hold and sell whenever you recover your initial investment. I hope it's clear. So this is what you're supposed to do if a stock is reclassified as a non-compliant stock. Now, the last area of discussion is with regards to purification of whitelisted equities. Now, here you have, like I said earlier on, stock purification, which is mandatory upon an Islamic principle sensitive investor. So, like we said, there are thresholds where impermissible elements of income are coming in. So there is a need to purify your stock. So stock purification is generally applied on 2 areas. So namely, they are capital gain or dividends received. There are 2 methods which I will share in just a bit. But for your information, in summary, it's namely on capital gains and dividends received. So purifying your capital gains remains a debated issue until date. Some scholars are of the view that purifying capital gains is not necessary because capital gain is a market earning that derives no direct income from the company, and that the change in the stock price does not reflect interest or impermissible income, whilst there are other scholars that advocate purification of capital gains. Now, if you look at the 2 methods that are in place, one is the dividend-based purging method, the dividend-based purification method. Now, under this method, and this is followed by some of the standards, the purging of impure income is primarily linked only to the dividends. Capital gain is excluded, and there's nothing to do with the share either, or your capital, because if you look at it simply, you are investing your money, your capital, into a business that, as per these standards, is the majority of it is permissible. There's a small component that is impermissible. So you have invested, let's say, 100,000 rupees as your capital in that business. So it only makes sense that when that business gives you profit, that profit is obviously is understood. The profit component that company is giving you, the majority of it is from permissible sources, but there is a small component that is coming from impermissible sources. So from that profit component, that tainted part that is coming from impermissible sources needs to be given out in charity. So as you can see, this is only applicable on the profit. Whenever you want to pull out your capital from the company, you will pull out your 100,000 rupees. And there need not be any purification with regards to your capital. I hope it's clear. So it makes sense that this be applied only on the dividend that is paid out. So this amount is calculated by multiplying the dividend received on the shares of the company held by the investor by the ratio of impure income to the total income of the company. Let me share the formula. It's basically dividend paid per share into the number of shares held by the individual into the permissible, by the ratio of the impure income. And by the way, when we say impermissible income, you have to bear in mind that it is the operating activities income or non-operating activities. It is not just the operating activities, it is the 5% threshold. It's just not that. You have to factor in non-operating activities income as well to the total income of the company. Because if a company has impermissible sources of income, it can be, like we discussed earlier on, from the operating income of the company or the secondary activities of the company. All of this has to be factored in when it comes to impermissible income, and the denominator is the total income of the company. Okay. So for example, if a company that sells cars, it also has a finance division, a company that manufactures and sells cars. It has a finance division that has a car finance product. So the income, simple income breakup of this company would be revenue from car sales being, let's say, 98 million, if you will, and revenue from interest earned from the car financing activity as being 2 million. So the total revenue is 100 million. Okay, 100 million. 98 million is from sales of cars. 2 million is from interest earned from car financing activities. So 98% is compliant, 2% not compliant. So the 2% that is not compliant, when an investor gets dividends from this particular company, he or she has to purify it to the extent of 2% from the dividends received. I hope that's clear. So this is one particular method of purification. The other method of purification is the AAOIFI purging method based on shareholding, the AAOIFI purification method based on shareholding. So this is the second method. Now, under this method, the purification is primarily based on interest earned per share by the company, rather than like how we discussed in the previous method on the dividend only received per share by the investor. This is on the interest earned per share. So according to this method, the purging amount is calculated by dividing the total prohibited income by the total number of outstanding shares of the company, and then multiplying the resulting figure by the number of shares owned by the investor. So this is the formula basically. Impermissible income, the denominator being total outstanding shares into the number of shares held at the year end. This is also another important point that you have to bear in mind if you are to follow this particular method. As you can see, the standard clearly states that purging under this method is obligatory upon the investor only if the investor holds the shares of the firm at the end of the accounting period. It is not applicable to those who may have held them during the financial period but exited before the year end. So the earlier approach, only dividends. I hope it's clear. This approach, you have to follow this formula, and only if you hold it during the until the end of the accounting period. Okay, so now that we have discussed all these standards, alhamdulillah, and we have come close to the end of the discussion, there's a $1 million question. Which standard should I follow? Now, from the 5 standards, which standard should I follow? From the the reclassification of the shares as being non-compliant, which approach should I follow? Purification method, which method should I follow? The answer to this $1 million question, my dear brothers and sisters, is that it can differ from market to market. It can differ from institution to institution, and it can differ even from individual to individual. So instead of me telling you which standard to use, I would like to quickly mention a few approaches on how you can use these standards to help you with your investing decisions. Approach number 1, stick to one standard. After researching and looking through the different standards, you may prefer one particular standard or one particular approach over others. And based on that, you will only pass your investments, you will only make your investment decisions through this standard, through this approach to determine the compliance of Islamic laws. This is one approach. Approach number 2, use any standard that passes compliance. So another option that is available to you is to ensure that your investment passes at least one Sharia standard. And if it does, you invest in it. So like Brother Shamir was highlighting on the website, each star, the stars are not in place to indicate superiority or inferiority of any company. No, it is just giving you information that this company has passed this particular standard. So like I said, with approach number 1, you may be particular or you may want to go with just one standard. So you will only look at that standard. Approach number 2, you can use any standard so long as at least the company has passed one standard. If it does, then you invest in it. You're confident to invest in it. It doesn't matter whichever standard it is. Your goal is to ensure that it meets the requirements for one of these standards. Approach number 3, use multiple standards together. So another approach would be to ensure that the investment you are looking at making passes all or multiple standards. So if an investment fails even one of these standards, you can choose not to invest in it. You can choose to, or you can choose to go through this route where you would expect an investment or a share or stock to pass multiple standards. But please bear in mind that choosing to use multiple standards does not necessarily make an investment any more Islamic compliant. Because the Sharia standards, these Islamic standards, were not built with the intention to be used collectively. These standards were not built to, cherry pick or mix them all up and use. So they were not used. They were not built to be used collectively. Rather, they were built to be used independently. Like I said at the very beginning, at the inception, they were built to cater to a certain market, to a certain demographic. You understand? So independently, they were intended to make sure an investment passes the principles of Islam, to be basically comply with all of that. So at the end of the day, you may use this approach where you use multiple standards if it gives you more peace of mind. Meaning, if you think that, I'm only going to invest in a stock if it passes 3 standards or 4 standards or 5 standards. You may use this approach if it gives you more peace of mind. However, you have to bear in mind that there is no evidence to support that this is a more religious approach. And lastly, before I leave you all, I'd like to share one more narration of the Prophet, peace be upon him, where he is reported to have said, when a man came to him, the narration goes along the lines of these words, and asked him about righteousness and sin. The Prophet struck the chest of the man and he said, and this is the narration, consult your soul, consult your heart, O Wabisa. The name of the companion was Wabisa. Consult your soul, consult your heart, O Wabisa. Righteousness, it is what reassures your soul and your heart. And sin is what wavers in your soul and puts tension in your chest. See, that prick of your conscience, it will tell you what is right and what is wrong. It is innate. We are hardwired. We are built with it. And look at the words of the Prophet. Even if people approve it in their judgments again and again and again. So you can have scholars, you can have standards, you can have all of this telling you something, but go consult your soul, consult your heart. And if you are at ease, the ball is in your court. You have all of this that we are doing with the help of Allah to add more value, to give you more information, and all of this research is being done to help you make a informed decision, inshallah. And I'm just receiving messages as well that in January, as and when the financials are released, it will be going live on the website, inshallah. That's the feature of the whitelist, the Almas whitelist. It's going to be live. So as and when we get the results, it'll pop up on the website. So you can access the website, look at the information there, and make a decision, inshallah ta'ala. So we conclude by praying unto him, the Almighty, Allah subhanahu wa ta'ala, the generous Lord whose coffers never run dry. O Allah, O Lord Almighty, we pray for a stable and prosperous economy and stock market. Ya Allah, you know the stocks that we own. Please help those companies to survive these tough and turbulent times and be able to continue to grow their businesses and start making profits. We ask you for clear guidance in our investment choices. We ask you to protect our investments, fill them with profit, and help us build pure and clean wealth. We ask you to open doors of good health, wealth, prosperity, and abundance for all of us. And we thank you for every blessing that you have conferred upon us. I'd like to now invite Mr. Rizvi, as we have another interesting product that we hope to launch very soon, inshallah. And he will share more details with regards to this one of a kind, first of its kind product, inshallah. So on to you, Mr. Rizvi.
Jazakallah. Thank you very much, Sheikh. Assalamu alaikum once again to all of you all. We have spent almost, I think, 2 hours, but going through a very important and very detailed, which allow us to enlighten whitelist screening process over 5 well accepted and widely used standards or parameters. And also we witnessed the launch of the interactive and more importantly, the live website of the Almas Equity with whitelist screening. Live, as the Sheikh explained, as and when the finance results comes out, as much as practically possible, we will update that on our website. So when a results comes is the best time to look for a stock to invest or rather take it, get on to that stock. So before do that, we give the facilities to our valuable customers to ensure that it goes through this training process. So our website will be updated. And also this process, as Sheikh Muiz explained very clearly, give you an informed and a knowledge-based decision rather than making assumption. So now let me take few minutes of your time just to explain another different aspects, but very much related and interconnected to the subject matter that we are discussing. That is, we have to be very mindful if we want to go through. As we all know, the buying power given by a stock brokering company and how it is get extended as a credit is an integral part of dealing in the share market. To clarify the same in big detail, unless otherwise we buy and sell on the same day, which is not possible practically, or it's not possible most of the time, using the buying power, it gets extended as a credit, which is the common practice in the market. So when it gets credit, that's mean from the T4, the T3 is the last day for settlement, and T4, any net amount in the account will be considered as credit, which is extended by that particular company. So generally the practice is the brokers charge an interest or a penalty, which may not be in accordance to the Sharia guidelines. So as our group chairman mentioned on his initial remarks, we at Almas Equities, as your trading partner, already in the process of formulating a product for such credit that may be extended for a set period at an agreed price as a Sharia product. We are almost ready with the product and working with our system provider to get the same incorporated into the system. This will be the first of this kind product introduced into the market. We will update market and our valued customers once the product is finalized and ready to be used through a similar webinar so that our valued customers can trade with peaceful mind, as such credit might be given little more days to do the turnaround, the buying and selling, and the entire process become within the Sharia guidelines. So with that remark, now I pass on to my colleague Ruzli Samsudin to give you the closing remarks and the vote of thanks.
Assalamu alaikum warahmatullahi wabarakatuh. I'm sure today's webinar provided valuable information relating to screening of whitelisted stocks. The techniques as explained by our presenters would have assisted you to understand different options available using globally recognized standards. The Almas website will further provide you the details of the whitelisted shares on an ongoing basis to make informed decisions. I would like to thank all of you, more than 100 participants who decided to take part in today's webinar to take the message to enhance your knowledge. I wish to thank the presenters who shared their insight about whitelist. Further, this webinar would not have been possible if not for the efforts of all our team members at Almas, and I wish to recognize their tireless efforts to bring the screening of whitelist a reality. And I also need to mention the support from our service providers, including website developers and content designers. Once again, a big thank you to all of you and wish you a pleasant evening. Good night.